Hi, I'm Kevin Ramirez with AAA Mortgage Training, an NMLS provider that provides the NMLS pre-licensing 20-hour course. I've been doing this for many years, and this is part 3 of my teaser series to show you just the experience, what it's like to be in my live webinar course, which of course is a bit different than some of the self-paced courses out there that really don't set you up for the same success I pride myself in. So let's jump in. I'm going to share my screen. So the big thing we're going to learn about today is the two main types of mortgage programs. There are two main categories, conventional loans and non-conventional loans. But what does that mean? We're going to dive in a little bit here in my visual. First, you should know that conventional loans actually are broken down into two subcategories, conventional conforming and conventional non-conforming. I'll explain what that is momentarily. A non-conventional loan, to put it simply for you, is a government loan. So it's a government-backed loan, such as FHA, VA, USDA. So it's a very simple way to think of it. Conventional, just not government, and non-conventional is a government-backed loan. So a conventional mortgage are loans that are not insured or guaranteed by a government agency. And there's two types, as I mentioned, conventional conforming and conventional non-conforming. So let's take a look at the first one here. Features of a conventional conforming loan. So we're just going to touch on some of the highlights. Fannie and Freddie, they're very specific. They have a 1,000-page document talking about all the rules of what makes a conventional conforming loan and if they will buy that loan on the secondary market. It has to meet the conventional conforming rules. We're going to keep it high level for you. So conventional conforming loans do not, or sorry, they do conform to the guideline criteria set by the government-sponsored enterprises. We call them GSEs, that are Fannie Mae and Freddie Mac. In my course, we would have already covered this in some detail. Well, typically for a conventional conforming loan, the max duration, the loan term that is, can be no longer than 30 years. You would write in the 30 years. This is how I conduct my class. You fill in blanks. So, of course, I keep you engaged and give you the answers as we keep going. Actually, usually the answers are on the screen for you too. This typically requires a conventional conforming loan, a 620 minimum FICO score. So sometimes that rule can be bent a little bit, but 620 is the standard minimum FICO score. Of course, FICO being the Fair Isaac Corporation from the classic FICO model that Fannie Mae and Freddie Mac use. To be a primary residence with a conventional conforming loan, if you're going to purchase this property, right, it's your owner occupied, your principal dwelling, well, you got to move in. The borrower must move into the property within 60 calendar days of the settlement. And settlement, again, we cover in our class. This is, of course, the funding. And this is the closing where the money is provided in the loan, where we define in depth in the class as well. So, one, you got to move in within 60 days of settlement, and you have to live there for at least 1 year before renting it out. At least 1 year before renting it out. So that's important. People try to game the system sometime. Primary residence gets the best pricing. It also has the best chance of getting approved, it has lenient guidelines, versus a second home or investment home has stricter guidelines and higher pricing. So things to know, and some people, customers know this and try to exploit this. It's us as loan officers to be intelligent and make sure that no fraud happens. Well, the maximum conforming conventional loan amount, it actually changes every single year. This is as of 2022. The new limit for Fannie and Freddie is 647,200. So 647,200 is what you would write right here. That's what it is right now for the a one unit property. So not a 2 unit or multi 4 unit in the 48 mainland states. Of course, I'm saying that Alaska and Hawaii are a little different. So the 48 contiguous states, right? So that was 647, 200, which is quite a jump from what it was last year in 2021. So that's a pretty big loan amount, right? However, there are some counties in America that are even more expensive than that. That 647, 200, maybe we'll get you a 1 bedroom condo. And that's not a funny joke. It's a little bit interesting the way things are going these days. But we know that, say, Los Angeles County or Orange County, California, or just various select counties across the nation, usually in the coastal areas, they're more expensive. So Fannie Mae and Freddie Mac recognize this, and they designate them Fannie Mae. That's the acronym for Fannie Mae. They'll refer to them as high balance areas or counties, and Freddie Mac will call them super conforming. Same thing, tomato, tomato, right? It's just saying some counties will have a conforming loan amount limit that is higher than that standard 647, 200 this year. Okay. And Alaska and Hawaii, they're expensive as well. So they actually kind of fall in line with this. They can have a maximum loan amount up to 970, 800 for a 1 unit property. Now, again, it depends on the county. Like, for instance, I don't have this memorized, but San Diego County, expensive, but maybe not as expensive as Los Angeles. So it won't be as high as 970, 800. It'll be a little bit lower. But LA County, definitely more expensive. It'll be at the max of 970, 800. So again, depends on the county. This is public information. You could Google this and look up the county loan limits for 2022 in this area and that area. But it's important to know there is distinguished high balance and super conforming counties, which are still considered conventional conforming loans. Just again, have a little different terminology and sometimes a little bit of different pricing too. So moving on with my teaser of the class, then we would talk about conventional conforming loans have certain debt ratios. We would have already learned the 4 C's of qualifying the loan. That's credit, capital, collateral, capacity, right? We would have already covered this in my class. So now we're talking about what is the maximum debt to income ratio, or DTI, that they talk about for conventional conforming loans. While the max that Fannie and Freddie want you to have for the housing expense ratio, also known as the front end ratio, is 28%. And the maximum that Fannie and Freddie would like you to have for the total expense ratio, sometimes called the back end ratio, is 36%. Now, I will say this is going off these standard guidelines. We are able to exceed these ratios, as I talk about later in my class. Now, they want typically up to 95% maximum loan to value, LTV, which we explained earlier in my class, for conventional conforming loans. I say most of the time. I'm talking nice and casual. So most of the time, a customer is going to have to put the minimum bar investment of either 5% of a down payment when buying a property, or have at least 5% equity left over, right, when they're doing a refinance. So we want the customer to say have some skin in the game, so to speak, leave some sort of a buffer for equity, as I explained in my class, why that's so important. So if you look at here, a little flashback to third grade, is greater than symbol. If the LTV is greater than 80% on a purchase, not a refinance, on a purchase, the borrower must use their own funds for at least 5% of the down payment. Now that's important to know because, again, sometimes customers can get gifts from relatives of various sources. But when we go above that 80% loan to value threshold, that loan's considered more risky by Fannie and Freddie because there's less equity there, less of a cushion, so to speak, right? So it's riskier. Well, we want the customer to have at least 5% of their own money used for a down payment of purchase. If the loan to value is less than or equal to, remember this from third grade, 80% on a purchase, the entire down payment may be a gift. Okay, so that's great to know. So as again, 80% loan to value on conventional conforming loans is kind of that magic threshold. Once you go above 80% loan to value, different things kick in, like private mortgage insurance, we talk about later in my class, and maybe the guidelines get a little stricter, as you can see. Okay. And I did say most of the time because you can go up to 97% loan to value on some conventional conforming loans, which is only a 3% down payment. Well, that sounds great. Well, this is only in certain circumstances. Fannie Mae and Freddie Mac, they have some programs with unique circumstances that allow to this, like, for instance, a first-time home buyer. If you're a first-time home buyer, then you can qualify for a lower down payment. Okay. Little thing here to talk about before we're done with our teaser. Conventional conforming loans also allow a maximum of 6% seller concessions. Okay, a maximum of 6% seller concessions, contributions on a purchase loan. So first, what are we talking about? What is that? Seller concessions or seller contributions is a percentage of the purchase price, right, or appraisal value, whichever is less. So we look at between the purchase price and the appraisal value, whichever one of those two figures is lower on this transaction, it's a percentage of that. Well, what is this about? This is a seller contributing to the borrower's closing costs, their settlement charges. So it's fantastic. It's a great way, again, if you're looking to buy someone's house and the seller is a little bit motivated, they can say, I'm going to put a little cherry on top. If you buy my home, I will give you back some of my profit from you buying my house, and I will give that back to you as a percentage, right, of the purchase price or appraisal value, whichever is less, but it gets applied to your closing costs. So just a way to sweeten the deal, the seller helping out the buyer, the seller giving some of their profit from the purchase back to the buyer to help out with their closing costs. Now, in most cases, this cannot be applied to the down payment. Okay, so very clear, apply it to help the buyer's closing costs, these seller concessions are not used to help out the buyer's down payment. Okay. So for instance, if I have a purchase price of 300,000 and that nice seller was willing to give up the 6% seller concessions, well, 300,000 times 6% is 18,000. So they could give up to $18,000 seller concessions. That is not common, but hey, it's possible. Of course, again, they give a little bit less than that. And you should know that really it's about what the seller's market, again, sorry, more of a buyer's market. A seller's market where the sellers have many people lined up, they're not as willing to give a seller concession. And a buyer's market where things are moving slow, you put your home on for sale and it's on the market for several days, if not months, not really any nibbles there. Well, that's a great reason, again, for a seller to sweeten the deal and give seller concessions. So, anyways, I'm gonna stop right there. I hope you like what you're seeing. Again, I'm Kevin Ramirez with AAA Mortgage Training. You can see I break it down a little easier. Of course, if we're in a class, we're going to be asking questions back and forth. I'm pausing for you. It's not just a lecture. So look out in the chat. I'll put the information on how to register for my class. Look out for more parts of my series. See you soon.